George, I gave a very, very short introduction. You will do it with your, of course, opinions and insights. We were at the Precious Metals Gold Conference, gold and precious metals, let's say. Bloomberg Venture organized it a couple of days ago, and it was a very interesting conference. And I would like you to share your opinion about the conference. But before that, let's talk about the initial session, which was bull versus bear case for the metals, especially for the gold. I know gold being the gold topic nowadays. And of course, we know the sovereign debt crisis, the global economic outlook determines it. So which way investors are betting nowadays, after we also listened and heard the talk about bull and bear case scenarios?
I think there's no doubt that based on what we heard at the conference, that investors are still backing the bull case. There's no question about that. The sovereign debt crisis obviously is very, very important. The general economic background is also very important for gold prices, but probably decisive is really what's going on in the gold market itself. The internal market fundamentals, the balance between supply and demand, has been growing more and more positive over the decade-long bull market that we've been in. So investors have felt that it was something that they could rely on, and every time there's a particular crisis, whether economic or political, then they tend to ramp up their gold buying. When things start to look just a little bit more peaceful and maybe the US economy is looking like it might have signs of recovery, as it has over the last few days, then maybe they lighten up a little bit. But that's what's happening. But the good thing about this market is every pullback has been perceived by investors as a buying opportunity, and that's really why the bull market has been sustained for such a long time.
Thank you for talking about the buying opportunity. You are the creator of the ETF, the GLD, now known as the big spiders. Our audience knows it as spiders. It's very important. You're the legendary name in this market. So talking about the buying opportunities, how are the investors investing? Are they investing in the gold, the physical gold? Are they investing in the ETFs? Or are they investing in the gold mining companies?
Yeah, I think that investors are really, there's really no one answer for investors, right? Investors will buy whatever is the appropriate thing for them to buy. Some people like the fact that gold mining companies very often pay dividends, and they also might have the potential blue sky for exploration opportunities, for example. If they're successful in exploration, their share prices can skyrocket. So that's the right investment for some people. For other people, they want the security of having the physical bars or coins in their own possession. And then there are the people who believe they were just waiting for the exchange-traded fund opportunity to come along to give them the security of allocated gold bullion stored in a central vault, but the convenience of trading on a regulated stock exchange. So they're using all of these methods if the bars and coins, the traditional ways of doing it, are still well over half of the investment demand every year. And probably the smallest at the moment is the gold mining stocks. And I think that's because gold mining stocks are having difficulty controlling costs, and they're having difficulty in exploration success. They're spending a lot of money on exploration for new gold deposits, but gold is very rare, very difficult to find, and the economics are still complicated, even with the price where it is over $1,600. So that the gold mining stocks have been underperforming relative to the bullion. That's not always going to happen, but at the moment that's what's happening, so that the bullion in one form or another, ETFs or bars or coins, is looking more attractive than the stocks right now. And let me just say one thing. I was part of the team that created GLD. I was not the father of GLD. I was part of the team that did it.
That's very humble of you to say that. And talking about the gold mining companies, yes, there is a lag. There is a difference between the performance of the stock prices of the gold mining companies and the ever-increasing gold prices, in spite of the decreases that we witnessed the last couple of days. But do you think operation cost is the only reason? Is there any other reasons that we should look underneath?
I think the problem of cost is a very, very real one. The energy is more than half of the cost of any mining operation, and that holds true for gold mining as well. And we all know what's happened to energy costs over the past decade. They've skyrocketed. But the lack of exploration success is also a real problem for these guys. In the 1990s, when gold prices were really depressed, gold mining companies couldn't afford to invest in their own futures. They couldn't afford to spend on exploration and looking for new gold mines. So it fell, spending on exploration and development fell by 70%, 70%, from the peak to the trough in the 1990s. It's now picked up a lot, and it's probably at record levels right now. But gold mining companies are still not yet finding enough new ore bodies to replace the ones that are becoming depleted and are running out of gold ore. And that's another real problem for them. The costs and the lack of exploration success combined means relatively poor share price performance for most of these guys.
Well put. Thank you very much. And let's go back to the liquidity issue. Some people in the market who are experts also, and some were at the metals conference, claim that liquidity is a problem. Gold is not as liquid. And also the market is small. Do you agree?
I don't. I think a lot of people, especially in the United States, they tend to look at what happens on the futures exchange, the CME, the gold futures exchange, as if that were the whole of the gold market, and it's not. Gold is a global market. It's very deep and liquid. You can trade in gold, buy and sell it 24/7. You can do it right around the clock and in many, many different centers. There's a huge and very liquid over-the-counter market in gold. I've never seen liquidity problems in gold as a whole. You might get a liquidity problem if the US Mint, for example, runs out of blanks for gold coins because of excessive demand. That will be a very short-term thing, and it's in one particular aspect of gold. But even while we've had that difficulty for the US Mint, not being able to get enough blanks to produce enough coins to satisfy demand, there was still plenty of 400-ounce gold bars, the things that investors buy and sell, the things that central banks trade among themselves, the basic numeraire, if you like, of the over-the-counter gold market. There was no shortage of that. So I don't think liquidity is really a problem. If you look at the gold market by comparison, for example, with sovereign debt markets, it's bigger than all of the sovereign debt markets in the world, all of the bond markets in the world, with just the exception of the US and Japan. So it's a lot bigger than the German bond market, for example. It's a lot bigger than the UK gilts market. And a lot of people simply don't realize that. Partly because it's a somewhat opaque market, being mostly done over the counter, with no reporting requirements to any central data collection agency. The reporting requirements are from trader to his own compliance department, to his own management, rather than to some central data collection agency. So the statistics don't get publicized. But if you delve into the market, if you actually talk to people who are transacting on a day-to-day basis, as the World Gold Council research has done, for example, then you'll find that it is a much more liquid market than people realize.
I want to talk to you forever, but we have last 10 seconds. Can you tell us about the outlook, the gold prices for 2012 and beyond?
At the gold conference, the forecast ranged, for the end of this year, the forecast ranged from $1,200, so a drop of another $400 from where we are today, but the consensus was around about the $2,000 mark for the end of the year. I think that's realistic, and there was one brave participant who said gold will go to $5,000 within the next 3 to 4 years. I wouldn't be at all surprised if that happened.
So you were not surprised to hear that?
I was not surprised. I know that the man is bullish.
5,
he is a gold mining company, but I think he has a very good chance of being dead right.
Thank you so much. We need to talk about the central bankers and the other participants in the market, the buyers, right? Next time, we need to have you here again. Thank you so much for coming.
I'll be happy to come back.